A recession is almost a certainty at this point, and this banking crisis that we're seeing unfold isn't even the real calamity we're about to see in our economy. This is according to our next guest, Peter Grandich, founder of Peter Grandich Co. So how exactly should we invest? Peter has the answers. Welcome to my show, Peter. Honored to host you today. Thank you for joining us.
The honor is equal, David. I'm happy to see what you're doing, and you're doing a great job so far.
I appreciate that. Now, Peter, we've spoken in the past about your bearish outlook, and things have gotten decidedly more bearish in light of this recent banking calamity. Is this the calamity that you had anticipated? Basically collapse or a process of collapse of the financial system?
Well, I'm not in the world's coming to an end camp, but in the end, by the end of 2021, my advice was to be completely out of the U.S. stock market, not related to anything commodity oriented. For a whole host of reasons. As you know, I stated over and over again that America had entered its worst ever social, economic, and political era. And we're just seeing the fallout from that belief continue in various areas, the latest being the banking crisis. I suspect that we're going to also see some serious issues in the real estate. We're going to see a dramatic slowdown into a recession. We have political paralysis in Washington. The two parties can't even look at each other, never mind talk to each other. And America is losing itself on the world stage as every day goes by. So, we can talk about a lot of things. There's not enough time in your show, but the banking crisis is just one of many issues that are going to make things tougher versus easier.
I do want to get into all those things. I know you have good commentary on all those things you brought up, but before we do that, give us a bull case, Peter. If you were to be bullish, what do you like about our economy, about our financial system now?
It would have to be based on valuations being way taken down. I feel still that the stock market is going to decline towards where the pandemic lows were made in 2020. At that point in time, unless things gotten even far worse than I imagine, I'm probably going to look to return to some part of the general equity market. But it's very hard to make a bullish case because much of what's been done over the last couple of decades, David, has been taken away from the future by borrowing against the future, by printing tens of trillions of dollars, cutting interest rates down to zero, and also a lot of the professional community that's been raised on a one-way street. And last year they learned it's a two-way street and there's even traffic circles. So the market would have to get a lot cheaper and not get any worse socially, politically, and economically than already what I think. And perhaps then I would go back, but not before.
Peter, there's been speculation that the Federal Reserve is not only done tightening rates, or raising rates rather, but in light of what's been happening, they're about to cut rates over the course of this year. Do you think that's in the cards?
Well, one thing I would be concerned about is it was clear up and through last Wednesday there wasn't cohesiveness between the Treasury and the Federal Reserve because while Jay Powell was saying one thing, Yellen, who predicted a few years ago we would never have a financial crisis again, was saying something else. And that really is one of the reasons the market peeled off that day. But I'm more concerned about them being in a corner. I mean, if inflation was as bad as they said it was, and what was just a month ago before the banking crisis, what they felt they had to do, they would have to see that there would be a dramatic change in the economy because of the banking crisis to really get rid of that inflation argument. I think at best, what we may see is them absolutely just stop for the moment and see how this thing pans out over a month or two. But they're still talking mostly as if they're going to slowly continue some raises, that they're not yet convinced. Now, I will tell you this, and it's not talked about a lot, but the BLS, the Bureau of Labor Statistics, has really fudged the employment numbers with a bunch of whole new ways that they decide how employment is versus from years ago. And I think that unfortunately has also made the Fed think the economy is stronger than it really is. I think soon we're going to realize that the economy isn't, and that could be the opening to the door for them to at least pause, if not, like you said, later on as a recession becomes evident, actually cut rates.
Let's come back to that. The unemployment figures are being fudged. How?
Well, for starters, they instituted a bunch of new seasonal factors, how they decide. Remember, for a lot of years, the BLS guesses on what new job creations are done. And when you look at the unadjusted, when they actually still go based on old seasonal, the number's much different. So plus, it's very hard to conceive that employment is so strong when major companies, one after another, are laying thousands, if not tens of thousands of people off. So I think that is going to be perhaps a reason in a few months to start to say, okay, this economy is really slowing down, if not in recession, and then they can make a different attitude. But I don't think they're yet ready to give up what they believe is a necessary fight on inflation.
I want you to transport yourself back 15 years, Peter, and remember where you were in the beginning of 2008, right around the Bear Stearns collapse, and then leading up to the Lehman collapse. How was sentiment around, let's say, summer? Lehman filed for bankruptcy in September, but how was sentiment like around the summertime of 2008, and how did that compare to what we're seeing today?
Well, I was lucky to step away from that one as well, but there was still a lot of deniers from Bernanke to a whole bunch of others that said, "Don't worry, this is not going to be bad." And I think the good news is the banking system as a whole right now, unless it really has bank runs, is I think in better shape than it was in 2008, especially the large ones. I don't think they're in the difficulty they were then because they had such large exposure. You have to remember one thing, and we never saw anybody really found guilty and put to jail, but we had major financial institutions around the world, but in the United States especially, not only selling short mortgages to people, but actually then taking short positions. And that would have been like a car company, not only knowing a car was going to crash, but buying life insurance on the people they sold the car to. So the banking institutions were a lot different then. So I don't think in that regard, where I think it's different this time is regional banks are the backbone to businesses, small to mid-sized businesses. That's who I deal with in my planning group. They don't deal with the major fours. They need the local regional banks. And there you're going to see them pulling back tremendously at a time when there is a turn down now in certain areas of commercial real estate. And that's going to take several months to see how bad that gets. It's not going to be decided in the next couple of days or weeks.
Do you think the local regional banks, because they were smaller in terms of capitalization, they didn't have to adhere to some of the regulations set forth by Dodd-Frank and other documents?
Yeah, you're absolutely right on that. And one big concern I have is this talk of insuring all deposits. I believe it will create one of the biggest moral hazards ever for financial institutions because if I'm that bank, and I know no matter what we invest in, even if it's really risky, that if things blow up, the government's going to come in and take care of the depositors. I don't think there's incentive there to be more conservative. I think there's incentive there to be more loose. So I'm very concerned about that. And let me just tell you, I have this slogan and I didn't create it. I took it from somebody. The elite get bailouts, the poor get handouts, and the rest of us pay for it. And I really think it was a mistake, as bad as what they think it was, to set the precedent that you're going to now cover all these people's investments. Listen, there's risk. You took the risk. You have to pay the price. And every time the Federal Reserve and the government's gone to a point where they can take the medicine and go through difficulty, but make things better longer term, they do the opposite. And they borrow from the future and add even more problems for it.
I remember back in 2008, well, after 2008 happened, in 2009, there was outright anger, if not outrage, across the United States amongst ordinary citizens about the bailouts. They were angry at the governments for bailing out the banks. Why bail out the big banks and not help the middle class, they argued. We're starting to see that again. Janet Yellen has pledged to support banks if they fail and insure depositors. The depositors are obviously happy to hear that, but what's your sentiment now about the bailouts? Should we be funding bailouts for banks because they're too big to fail?
I don't think so, but I understand why they do it because the, the regular people like us don't run the country and they're not involved in that end. And what people haven't talked about is if banks are facing that issue, what about pension companies, many of which are underfunded, and insurance companies? They all basically buy the same stuff. Now, the insurance company's got a little safety valve because not everybody's going to suddenly show up and say, okay, I want my cash value back, cancel my insurance. But the pension companies, who really many are underfunded, had a bad year last year, not having a good year this year. Some pensions are going to be in serious, serious trouble if things don't turn around. And how do you keep bailing out? Well, we're bailing out with phantom money. It's not like we're selling an asset somewhere else so we can take care of these people. We just keep creating trillions and trillions and more of debt. And there comes a day when you just can't do that anymore. And we're approaching that.
There's another big risk people have been talking about, which is the refinancing risk of corporations. They're still running on interest rates from a few years ago, and they've locked in rates. But now some of those rates are about to expire either this year or next year. They have to refinance, and when they do, they're going to have to do it at the new higher rates. And the concern is that some of these companies, some of these zombie companies, they call it, aren't going to survive. Is that a legitimate concern?
I think it is. And I think also a big concern is I live in a 55 and over community where I reside in New Jersey, the second biggest county in the nation for seniors 55 and over. And so many of them tell me how much they bought stocks with dividends in order to continue their lifestyle. In fact, some say to me, I don't care if the stock's down 20, 25%. I just don't want them to cut the dividend. One of the things that's going to happen if we have a hard landing, and I still think that's up in the air, we'd all be guessing. But if there is a hard landing, we go into a pretty rough recession, we're going to see significant dividend cuts. And that in itself, on top of retirement accounts last year, David, were down 25% according to Fidelity. Throw on a 10 to 15% or more of inflation, and then throw on the fact that people are seeing their dividends cut. It's going to be very, very difficult for certain types of people to maintain the lifestyle they've grown used to.
All right, I know that you have this outlook that stocks are not going to recover to new all-time highs anytime soon, and I want to talk about that. But let me just insert a bull case for you to either accept or debate. I have no debater for you today, unfortunately, so I'm going to have to play that part. Now, the Federal Reserve is in a precarious position. On the one hand, they have to tame inflation, which is not quite at their 2% target yet, although on paper it's been coming down. But this stimulus effort from the side of Congress to bail out the banks, that's provided liquidity and will continue to provide more liquidity. Basically, bailouts, bank bailouts are stimulative, people argue. And so we could see a scenario in which the Federal Reserve steps in and outright reinitiates quantitative easing to ease the overall real economy. And when that happens, it's like another hit for the stock markets. We'll see a huge melt up, is what people argue. What do you think?
Well, that Kool-Aid is no longer the only Kool-Aid in town. That worked when there was nothing else for people to do. We were on one straight line going up. People now are in far worse shape. David, we have a community now in the United States where almost 75% of Americans are working paycheck to paycheck. On top of that, they saw a dramatic increase in everyday costs that they had to use credit cards to record levels just to get through things. I'm going to tell you that if you're fortunate enough to get this rally that you say could be possible as a bull, I think people will use it to lighten the load, not to get re-energized and heavily invested again. And by the way, if you can bring back that bull guy I debated and see if he can beat me this time.
Well, let's see if we can arrange that. I think the gentleman you're referring to is David Barse. We had a debate a while ago. Great guy. So, Peter, let's talk about your outlook for the economy overall. Well, I know it's not great. We've talked about some of the concerns that you have, but are we going to get an outright recession this year?
Recession is, I think, almost a given. It's whether it's a soft one, as they like to say, a soft landing, which very rarely happens, or something more significant. There's just no way around it, and it always takes a few months after it's actually taken hold before it really starts to show. But I really think before the end of the year, it'll be obvious to everybody that we were in a recession. And like you said, at that point, the Fed may have to make a choice, especially if they got inflation down to what I think it's only going down to about 4 or 5%. I think the 2% number is just not doable. But if that happens, then of course you can have that cutting, and that's when you can have the dramatic bear market rally that if you want to make the so-called bull case. But I don't think it can happen until we get to that point.
You said the housing market is in peril as well. How's
Well,
that?
the housing market is petering out. Where the real concern now is, because of this crisis, is in the commercial real estate, particularly office buildings and all. And a lot of people put money into REITs again because they were forced out of the fixed income market because the Fed destroyed it by bringing interest rates down to zero. And now there's some concern of their ability to pay their dividends as well, because many of those local banks lend money to those real estate places, and they're going to have to be more conservative now. So again, these things don't play out in a day or a week. They take several months. But right now, for real estate in general, we've certainly seen the highs. I think commercial real estate is changing. The pandemic changed the way people go to work versus working from home. And there was a lot of office space that's still not being taken. And that's going to be an input on those commercial real estate companies.
I guess the question everyone watching this right now is probably thinking, Peter, in light of all this, then, where do I park my cash? What do I do if I'm an investor, given that we're entering a period of pretty much certainty when it comes to a recession, and we have all these other issues that you talked about?
Well, in 2021, I debated the man that at the time I didn't debate him directly, but I debated him through my own comments. If you remember, it's very famous. He said cash was trash, and I said cash would be king. And I think now most people would be happy if they had cash versus anything else at this point in time. Again, I still think that cash, I think, this may step us forward, but I really think you have to own physical gold. And the reason is, David, is you have to own it and hope it doesn't go up. And people say to me, why do you want me to buy something if you don't think it's going to go up? Because most of you have still a lot of your money in financial assets. And if gold goes up a lot, I can assure you your financial assets went down. You should almost be happy that you hear your gold went down, because that means your financial assets got better. So I still think cash is the most important thing at this point. Treasuries, are the safest of paper assets. And I believe that there are certain commodities that have an argument that, regardless of what may happen this year, over the next few years, can do rather well. But that's about all I can see at this point in time where I would want to be an investor in.
Well, let's just talk about gold. Now, one of the arguments for holding gold, especially during periods of high volatility, is that it is a stable asset with relatively low volatility compared to stocks and cryptos and other things that are high risk in nature. That makes me just think about cash. What are the advantages of holding gold relative to cash, which has no volatility?
Well, I think you always have to have cash because there are going to be opportunities come along and you want to be in a position. But gold doesn't have anybody else's liability. You're not buying somebody else's liability. Even when you buy a treasury, you're buying the liability of the United States. But I think gold has been rallying for a couple of reasons, and the bank issue has only added another. The first is it's clear that people are realizing that the end of the dollar is coming, that regional trading systems away from the dollar are developing, might even get larger through the BRIC nations. And also, people don't want to hold the dollar because America is losing its way, or the way people viewed it, and they want to diversify. And they don't see any other paper currency to do it. So that's why central banks in particular have been huge buyers of it. And I don't see that ending. I see that continuing. And now we saw in the last couple of weeks, bullion dealers were selling out their physical bullion. And that means the public has finally come to recognize it as well. So while the paper market, as we speak, may have us down because there's a huge bank with a big short gold derivative position, longer term, gold and cash, I would want to own gold and cash before I'd own stocks and bonds.
Gold has just recently breached $2,000, although very briefly. This is the first time I believe it's happened since last year. This momentum, some argue, is likely to continue. The question is, until what level, until when? What do you think?
Well, I actually think there's fairly safe play for people that aren't in gold at the moment. There's a cup and handle formation, a technical formation now that has come about. It goes back over 10 years. And we're at what's called the handle part. And realistically, if it breaks above the handle, we can get calculations anywhere to 2,500 to 3,000 or more on gold. And if it breaks below the handle, we could look back at gold at $1,000 or $1,200. So if you're not in and you really want to wait to like what could be almost a certainty, there's no certainties, but something that would be highly favorable for you, is wait to see how it goes through that. Now, fundamentally, the physical bullion market, the banking crisis has only made it more favorable. But technically, we still have issues where traders are going to keep selling it up at this 2000 or so level. Because as you said, we've been there twice before and didn't get through. And if you're a real short term trader, there's an old slogan, keep selling it until you can't sell it anymore because it doesn't work. And so we really need to break through 2000 convincingly and stay above it to really get our market going higher. I think it will do that. And that's why I believe when we do it, we can see a new all-time high in gold.
Okay, let's come back to your call about the stock market's not recovering for a very long time. For how long will it stay flat? And what's your thesis here?
Well, I think at least for the next year or two, it'd be very difficult to see any substantial gains. And it doesn't mean there's not going to be significant bear market rallies. But people who've grown used to double-digit returns, I think, are in for a serious problem. And where I see that, and I put on my another hat for a moment, I'm part of a large financial planning group here. And a lot of people who are first coming to us because we focus on cash flow, not net worth, they follow what's conceivable, what most people do in financial planning, the 4% rule. You put most of your money in stocks, the market goes up, you take out 4%, which covers whatever your expenses are. Market goes back up again, it continues. Well, last year that didn't work. In fact, it set them back a lot. Plus, we had higher inflation, so their purchasing power has been taken away. If we have another year that the market's just flat, let alone down some again, those people who have already retired, many of which are boomers, are going to have to make a very difficult decision because either they're going to have to cut their lifestyle or gamble that somehow the market always comes back, is what they're hearing from their financial advisors now. That's not the case. There's been past histories where the Dow took 27 years to get back to its previous level. So I just don't see how, with all the fundamental social and political issues, many of which we didn't even discuss yet, how the market can have substantial gains. I think there'll be tremendous bear market rallies, but unless you're a trader, I just don't see how you can make a lot of money in general equities at this time.
What needs to happen before we see significant corporate earnings growth again and perhaps corporate valuations expansion?
Well, David, I know I'm at this almost 40 years. The stock market is completely different from what it was when I entered. When I entered it, 90% of it was retail trading. It was buying part ownership and selling part ownerships of businesses. Now, over half the people that are involved in it are using some sort of quantitative trading system, don't even care about fundamentals, may not even know the name of the company or the CEO. And then the other half are in passive funds where they're just trying to track an index. So is the stock market going to return to what it always used to be? And that's part ownerships of businesses. And if that's the case, the number one impact on businesses is an economy. So if you're not a believer in a strong economy, which I'm not, then you can expect strong earnings and higher stock prices. And that's my thesis.
Okay, what's your view on the gold mining stocks then? If you're bearish on the stock market overall, presumably you would be bearish on the gold miners, or am I incorrect there?
Well, there's good news and bad news there. So let's cover the good news first. There is fundamental reasons that certain types of metals are going to be much more needed if the world continues to move where it's going towards electrification, et cetera, et cetera. And irregardless of how, if we have a recession for 12 or 18 months, if you're still an investor that invests out 3 or 5 years, which people used to, there's a great argument for certain metals, copper being one, zinc being another. So I don't mind focusing there. The difficulty now is that mining companies have a much more challenging time. Let's first take the majors. You could have took a globe 30 years ago, spin it, put your finger, land on a country and say it's okay to go there. Let's go looking for minerals. It's not the case anymore. It's much more difficult for a lot of reasons. We've seen Panama just suddenly tell a mining company, we don't want a 2% royalty anymore. We want 20% or you're out of here. We're seeing terrible uh, strikes and troubles on mining in some places in South and Latin America. So for major mining companies, it's a lot more difficult than it was a few years ago. For junior resource companies, and I think I sent you a chart to show you how really undervalued they're coming historically, they have even a bigger challenge. And I'll just cover two quickly. I did a whole video about it, but I'll just cover quickly. The first is it's much harder for a junior resource company to market to the end user, the buyer of the stock. Because years ago, financial advisors, Canada, US, built book of businesses around mining stocks and all. So if you got that one guy or gal who was an advisor to like your company, you got that 2, 3, 400 clients. Almost no one has a book of business of individual stocks anymore like that. So now they have to get to those 300 or 400 people individually. That's much of a harder challenge. The other challenge is overregulation. Here in the US, you can't even, if you're a financial advisor, accept an unsolicited order on a junior, even if it has an OTC symbol down here. And then finally, the third difficulty is because the market has been very, very tough and share prices have come down a lot, raising capital with already the amount of shares that companies have out is really, really going to be difficult. We are probably going to see a lot of mergers out of necessity in the junior market because it's at this point in time, it's probably at one of the worst sentiments that I've ever seen. You would think gold was 950, not 1950, if you just look at the junior resource market.
I'm going to finish on this question. Suppose this banking crisis never happened. Suppose these bailouts weren't underway. Would you still be bearish on the economy?
Well, let me tell you my biggest thing that I popped on now for weeks, if not months. We're going to have a retirement crisis. We actually already have it here in the US. As I said before, 75% of Americans are working paycheck to paycheck, and they've had to now resort to credit cards just to pay for necessities. Those people are incapable of saving for retirement. In fact, studies have come out and shown less than 12% of people have adequate savings for what they view as going to be a satisfied retirement. With that, with people living longer, we're also going to have a battle not only of the demographics, but ages. One of the issues that we face in the US now is the potential insolvency of Social Security. It's a real item, but also Medicare and Medicaid is going to have to, expenses are going to go up higher. So in a few years, we're going to watch younger people work and being taxed more than I was taxed as a percentage when I was a young person, and saying to themselves, wait a minute, there's an 85-year-old person that's getting 300,000 operation for something. Forget about it. Can't afford it. And then the older person is going to say, well, I paid in all these years and I want to have this operation. I want to live. And that is going to be a battle. We've already started to see it in your country, in Canada, where they basically have not greatly encouraged, but didn't deny older people who were suffering great illnesses or just a lot of issues end of life. We here in the United States, we have 10 states now that have assisted suicide. And that interjects into spirituality, which I try to keep out of my general views, but it is very important to me. And there's a culture of death now. So we can go on other social issues. There are big political issues. I mean, listen, if I can end it this way, David, when your prime minister was meeting our president, I said to someone, it's the only time that if they both traded places, each side would think they got the short end of the stick. So politics in North America is also a major issue. So I don't see that getting better either. That's why I can't come up with any real positivity at this time. Trust me, my business would be a lot better off if I did, but it's not what I see. And Mark Twain said, if you always tell the truth, you don't have to remember what you said.
Well, since we went there, how is the political situation tied to the financial markets? If, as an investor, you're looking at this and you're thinking, okay, this has an effect. How?
Well, look at the arguments already here in the U.S. about our who's going to pay for Social Security. One group says this, one says the other. It's Congress that passes all supposedly the fiscal policies. Talk to a business owner here in the US that's been around 20 years, and they'll all tell you almost all the same thing. It's never been more difficult to be a small business owner in the United States. And where does that come from? It comes from fiscal policy that comes out of Washington, where two parties won't even talk to each other. And I think there's also, to some extent, that discrepancy in your country as well.
Well, let's just finish off on the retirement issue. So if younger people who are going to be older people in a few decades aren't going to be saving enough for retirement, as many people think, it's not just you, what's going to happen then? Either the government starts paying a lot more in Social Security, where all these people are going to have a very, very hard time, right?
Well, there's more and more people getting in the wagon. And those of us who are left to pull, it's making it more difficult to pull and also tempt us to get in the wagon. And eventually, we'll get to the point where people are just going to go like this to the government, as they always do, and say, you have to help me. And we haven't even talked about major problems with senior housing and low income housing. You know, everybody wants to have somebody come that pays little to cut their grass or be housekeepers, but those people can't live in those same towns and all. I mean, you can open up a Pandora's box and we can talk for hours, David, but I'll just tell you this. Never has America, or at least the United States, been in a more difficult social, political, and economic era than it is right now.
Is it necessarily worse in America? I mean, this problem you're describing is not exclusive to America. Take Japan, for example. The United Nations is projecting that by 2050, the dependency ratio in Japan is going to be nearly 1-to-1.
Yeah, I'm not disagreeing. I'm focusing on where I'm at and what I'm still paid to talk about, and that's the United States. But you're absolutely right. It's not limited to the United States. In fact, that's why you're seeing BRIC nations, certain countries wanting to be more involved in that and all, because they just feel the way we've gone and what we try to influence around the world doesn't work anymore. And I think they have a good argument.
Hopefully there's a light at the end of the tunnel, but I do thank you for your time and your discussion. We've learned a lot from your wisdom, and very honored to host you my first month of my new show. So thank you for joining me, and thank you for enlightening us today.
Thank you for having me, David. God bless.
And thank you for watching. We'll have more for you. Don't forget to subscribe.